Hi, my name's Tom Elliott and welcome to another financial market update for Hodges Real Estate. Well, all sorts of things have happened in the past few weeks which have had some pretty severe impacts on financial markets around the globe. Now, firstly, of course, we had the US election. It was one of the tighter elections, at least for the presidential race, that we've seen in recent decades. Now, it's probably fair to say that Wall Street and business might have preferred Mitt Romney to get up. Having said that, Barack Obama is a known factor and business knows exactly what they're getting with him. Of course, the biggest problem that Barack Obama faces in the short term is the so-called fiscal cliff. Now, just over 4 years ago, former President George Bush Jr. Decided to enact a whole lot of tax cuts and spending increases. Now, these tax cuts and spending increases had sunset clauses built into them, and lo and behold, those sunset clauses kick in February 2013, i.e. within the next 3 months. So one of the first things Barack Obama has to do with a Congress which is still dominated by the Republicans is try and have the tax cuts and spending increases extended beyond February 2013. If he can't do that, then there's a fair chance the US economy could slide back into recession. And that's one of the reasons that financial markets have been rather unsettled the past few weeks. Interest rates. Now, we saw in October here in Australia, the Reserve Bank decided to cut rates again. I must admit I was surprised that in the November meeting of the RBA, the bank decided to sit on its hands. Of course, we have an Australian dollar, which is still very, very, very strong. It's still above and around about 104 US cents. It's making local manufacturing very uncompetitive, and we're seeing that in industries like the car industry, for example, which is really starting to struggle, at least when it comes to locally made cars. Now, the Reserve Bank could cut interest rates further, and I think this would probably bring the dollar down a bit, but it might not do that much. Remember, our rates have already fallen a lot over the past 12 months, and yet the Australian dollar is pretty much where it's been for the past year or so. So I'm not sure that cutting rates is the answer there. And perhaps another reason that the Reserve Bank could leave rates on hold now is that consumer confidence finally is showing signs of picking up. And this is because people are realising that, well, eventually if you keep making it cheaper for people to borrow money, eventually they might go back into the shops. We'll have to wait and see. Other things we've seen, of course, Hurricane Sandy. It did have a pretty tangible impact on the shares of QBE Insurance here in Australia, and it might affect the market for insurance, that is, make insurance prices more expensive over the next 6 to 12 months. In the short term, it will slow down the US economy, but in the longer term, with all the rebuilding and the cleaning up and so forth, Hurricane Sandy, a bit like the tsunami in Japan a year and a half ago, could actually be positive for US economic growth. Now, going back to the share market in general, it's very, very hard, as I've said, to tell where it's going to go at the moment. I mean, will the American government be able to do a deal with Congress? Until we know whether or not that deal has been done, the share market will almost certainly stay very, very volatile. Now, finally, before I get on to how the property market is faring, I just want to mention the federal government deficit, that is the budget deficit. And there's a few rumours doing the rounds in Canberra that in fact the federal government might actually go to an early election to avoid the embarrassment of the budget not getting back into surplus, as Wayne Swan and Julia Gillard have promised many, many times. Frankly, I don't think this government will go to an early election. One is they're still worried they would lose. Secondly, the deal they did with the independents, Rob Oakeshott, Tony Windsor and so forth, was that the government had to go full term. That means an election really shouldn't occur until September, October 2013. Finally, the property market. Well, as we mentioned earlier, lots of good news around the place as far as interest rates being lower. I do think the Reserve Bank has still got 1 or 2 more cuts up its sleeve, but as the flood of cheap 2, 3 and 4 year fixed mortgage rate money is telling us, borrowers can already go out and get a fantastic deal. And there's no doubt, in the same way the consumer confidence is getting stronger, real estate agents I've been speaking to suggest that even though the clearance rate is still around about that 60% level, there's renewed enthusiasm for bidding. We've had a lot of properties coming onto market and they've been selling. And indeed, average prices are starting to show some sort of upward movement. Now, one swallow does not a summer make, but the fact is when you've got low unemployment, and it's still at 5.4% here in Australia, which is very low by global standards, combined with cheap money and the willingness of banks to lend, property prices rarely stay down for too long under these circumstances. We'll have to see. Anyway, I'll look forward to your company again next month for another financial markets update, care of Hodges Real Estate. Thanks very much.